All right. Well, good afternoon, financial professionals. Dan Peterson, president here at E4 Insurance Services, and I'm welcoming you to The Brew, building relationships every week. Thanks for tuning in today, and for those of you joining The Brew for the first time, welcome. And we'd like to start the Brewcast as we normally do in our tradition of celebrating today's National Day, March 23rd, National Chip and Dip Day. Seems kind of appropriate with March Madness that chips and dip would be celebrated as the perfect combination loved by many across the country. Chips and dip are a quick and easy party dish that also makes for great parties. Enjoy them in just about any occasion, March Madness notwithstanding. From watching the game to hunkering down for a big storm, chips and dip are the way to go. So celebrate National Chip and Dip Day. Today on The Brew, we're really pleased to celebrate and showcase Mutual of Omaha and one of their awesome indexed universal life sales ideas. And we have Dave Weber, Life Sales Director. He's been with Mutual of Omaha for 20 years as Life Sales Director. He provides support, case design, product training for BGA offices and advisors around the country. He's a Husker, a graduate of the University of Nebraska with a degree in business and finance. I won't ask him how March Madness fared for Nebraska's basketball team this year, but and he's earned a CLU designation from the American College. He's married to Betsy, and they have 3 grown children, 2 of which got married last year, we found out just a little bit ago, and a golden doodle named Mose. He's obviously an avid Nebraska Cornhusker football fan, and he's patiently waiting for the Huskers to rise again. Dave's going to bring to us Mutual of Omaha's Life Protection Advantage and Income Advantage IUL products and some sales ideas around that. And I can't stress enough how competitive this product is. The lowest internal cost in the industry, very competitive guaranteed premiums, very competitive income solves at age 55 and older, and a chronic illness rider always included in the product, not an extra add-on, and a guaranteed refund option that provides 100% return of premium guarantee years 20 to 25. So we've seen people, the interest in this product pick up, and we're really excited that Dave's here to share with us. Feel free to use the chat box to share your thoughts or questions with Dave. We'll be keeping an eye out for those. Also, all attendees are in a drawing for a prize, and we'll be announcing the winner at the end. Thanks for tuning in. Dave, the mic is yours.
All right, thank you, Dan. I appreciate it. You stole a lot of my thunder there. But in any event, a great plug for chips and dips too. I love chips and dips, so great plug for that. But as Dan said, my name is Dave Weber. I'm Life Sales Director here with Mutual of Omaha. And if you're not familiar with Mutual of Omaha, or you're not familiar with our IUL products, I think you're in for a treat today because we have some of the most competitive, as Dan said, IUL products in the industry. We have 2 IUL products. One is the Income Advantage, which is our cash accumulation type product, and the other is our Life Protection Advantage, which more is our protection-based product, which I'm going to focus on more today. But our products are very simple, easy to understand. We have no bonuses or multipliers built into our products, so they're true zero floor IUL products, which is, I think, why IUL, what IUL was intended for, with a zero floor. So they're S&P 500 is the only index that we use. So they're easy for you to understand and easy for you to explain to your client. As Dan had said, we've got some of the most competitive IUL products in the market because of that low-cost structure. On the Life Protection Advantage product, we do have a death benefit guaranteed to age 90. We just upped that from October. Back in October, it was age 85. We upped that to age 90. But even outside of that age 90 guarantee, because of the low-cost structure, the product carries well beyond age 100 when you stress it out at 3%, 4% interest rate. It's got some very unique features. One is the guaranteed refund option rider, which Dan had mentioned. This feature, if the insured, if the market goes completely south, the insured has the opportunity to get back 100% of their premiums in years 20 through 25 for qualifying cases. And that's typically age 60 and younger. And it's not included on some smoker cases and some cases that are rated. But it's a great feature to have in terms of flexibility for the product, because like I said, if the market goes completely south, that client has the opportunity to get 100% of their premiums returned. We also have a long-term care rider that can be added. It's a reimbursement rider that can be added as a cost. We're the #1 standalone long-term care carrier in the industry. So our long-term care rider is one of the best out there. We have a care coordination benefit that's second to none. So the insured has help from Mutual of Omaha to find a facility and help manage those bills and those costs as well. What makes us most unique, I think, is our chronic illness rider. The chronic illness rider, if the insured cannot qualify for the long-term care rider, or if they simply don't want to pay for a long-term care rider, they will always get the chronic illness rider. If we issue a life insurance contract, they will automatically get that chronic illness rider, and that's regardless of their age, face amount, or rate class. And that's very unique to the industry. So let's talk about the chronic illness rider a little bit. It's up to $1 million benefit, or 80% of the death benefit, whichever is less. That's $500,000 right now in California. It's an annual lump sum indemnity benefit versus the long-term care rider, which is reimbursement. There's no upfront cost for this rider, so if they never use it, they'll never have to pay for it. But we do take a discount at the time of claim, and I'm going to go through an example of how that works right now. So let's say the insured has a death benefit of $500,000. That would mean that the benefit that they would have for chronic illness would be 80% of that, or $400,000. Now, with this benefit, they can request however much they want. Once they're unable to perform 2 of the 6 ADLs, they can make a claim and they can say, I want $20,000, I want $50,000, I want $100,000, or I want all the way up to the IRS per diem, which right now is around $140,000. They can take out in a lump sum however much they want up to that IRS per diem. So what we do is when they make a claim, we get their medical records. It's all based on their life expectancy, the discount factor. So once we get their medical records, we determine what their life expectancy is. In this particular case, it's a 3-year life expectancy. Now we base the discount factor on the Moody's bond rate, which right now is somewhere around 3.5%. But for the purposes of this example, we're using a 4.5% discount rate. We can go no higher than 6%. That's the maximum we can go for the discount rate. So again, in this example, we've got a 3-year life expectancy with a 4.5% discount rate. We're going to discount what they want by 13.5%. So in this particular example, they said, I want to get $100,000 out of the contract to help pay for some expenses. So we take 13.5% out of that, which is $13,500. Each year that they access the benefit, they pay $100, and we'll send them a check for $86,400. Okay, so now their death benefit will be reduced to $400,000. The amount that they have available for the chronic illness will now be $300,000, and the next year we'll go through the same process. So again, if they're still unable to perform 2 of the 6 ADLs, presumably next year their life expectancy will be 2 years. So it will be 2 times the 4.5, or whatever the Moody's bond rate is, which would be 9% in this case. So we'd take out $9,000 and the $100. So we'd send them a check for roughly $81,000 next year, or $91,000 next year. So that's how the chronic illness rider works. Here's the idea for the chronic illness rider. The insured has a need for $3 million of permanent coverage, and they cannot qualify for the long-term care rider, or they simply don't want to pay for the long-term care rider. So option 1 is the client purchases a $3 million policy, life protection advantage policy, which automatically always includes that chronic illness rider. They now have access to $1 million for long-term care expenses. So the problem with that is whether they have $3 million, $5 million, $10 million of coverage, they're only going to get up to $1 million of coverage for chronic illness. So here's the solution. Option 2, again, the insured has a need for $3 million. They're not going to health qualify for a long-term care rider, or they don't want to pay for it. So instead of purchasing $3 million policies, they purchase 3 $1 million policies for $1 million each. Each of those policies includes up to 80% for chronic illness. So each of those policies will have $800,000 of chronic illness coverage. You multiply that by 3, the client now has access to $2.4 million for long-term care related expenses. So by splitting those policies, the insured has increased their chronic illness benefit from $1 million to $2.4 million. Now, the great thing is the total cost of insurance has remained the same because we banned this product at $1 million. So it's the cost of insurance is exactly the same for 3 $1 million policies as it is for 1 $3 million policy. We've also added flexibility with that guaranteed refund option rider. Let's say 20 years down the road, they no longer have a need for $3 million of coverage. They can cash in 2 of those $1 million policies, get all of their money back, or the cash accumulation value if it's higher, and use that money to, for whatever they want. They can go on a trip. They can use that money to pay off the other $1 million policy. So again, it just adds more flexibility to the policy rather than just having 1 $3 million policy. And again, the great thing about this, it can all be done on one application. So in fact, I had a case a couple of weeks ago where the agent sent in 5 $1 million LPA policies so he could increase that chronic illness benefit, no additional cost to insurance, and he did it all in one application. The second idea is using the long-term care rider along with the chronic illness rider. Now, I know this is hard to see. This is a nice piece that you can share with your clients. I'll send this out to E4 and they can send it off to everybody that's on the call. But instead of just splitting policies with the chronic illness rider, if you've got someone that can qualify for a long-term care rider, a good idea might be to have one policy with a long-term care rider and one policy without the long-term care rider that includes the no-cost chronic illness rider. What that will do for them is actually cut down on the cost that they're paying for the coverage. In this particular example, they're using a $2 million need. So they split the policy into a $1 million policy with the long-term care rider and a $1 million policy with the chronic illness rider. Again, what that does is cut down on their premium. And number 2, what it does is they can access that long-term care rider first because they know exactly what they're going to get. They're going to get 2% or 4% of the death benefit. Once that benefit is exhausted, then they can go use the chronic illness rider if they need to, because by that time, their life expectancy would be less, 2 or 3 or even 4 years less than what it would have been before. So now that discount factor is going to be a lot less and they'll get more out of the policy. So anytime that you've got a need of $2 million or more, you'll always want to consider splitting those cases into 2 or more policies. You get the added flexibility of the grow rider and you get more coverage with the chronic illness rider. So even if in this particular case, the long-term care rider and the chronic illness rider split, even if you've got a case for $500,000, it's a good idea to take a look at splitting between $250 and $250. They are going to pay more for the cost of insurance, but they're not paying for that extra long-term care benefit on the chronic illness rider policy. So I hope that makes sense. So thank you for joining me today. I hope that you will consider all of your IUL cases with Mutual of Omaha, and I hope this has helped and hope it might give you some ideas for the future, especially those cases with the hard to place LTC riders. Thank you.
And Dave, we had some success last year with it was an estate planning case, and they ended up splitting the $10 million of benefit, a $5 million and $2.5 million, and the trustee and the attorneys really love that guaranteed refund option. The ability to know, and you mentioned age 60. That's the age and when the policy is issued, and it's actually available.
Correct.
Up to age 60, or is it age 65 on the? protection?
Up to age 60. So if you've
60.
got a 61-year-old, it will not be included. The grow rider will not be included. Correct.
Right. But
I will
a
say,
55-year-old, you know, you get out 20 years, so at age 75, if let's just say it's a business case, another great example, you know, business wants to purchase key person coverage. They know that at age 75, for that 55-year-old executive, they have the minimum guarantee of getting their money back that they paid for the coverage, or in the indexing situation, if it's greater than that, they'd have the cash value of the policy if they didn't.
Exactly. And again, the entire time they will always have that chronic illness rider just in case they need to use it.
Right. And that's for the owner to exercise. Again, it could be a business situation as well. But yeah, we've had success in seeing the attorneys and trustees really like the flexibility by splitting it into multiple policies. You know, if they want to surrender one policy, get the cash and apply it to help make payments on the other policies, provides a lot of flexibility, and it's very attractive. And I think the other thing we've seen is that the protection-based IUL product is one of the lowest costs to carry to maturity of any product in the marketplace. And that's really due to your low-cost structure, isn't it?
Absolutely. And I would recommend that if you're running illustrations on the product, certainly print out the cost comparisons and compare that to other policies out on the market. I mean, if it's a competitive situation, you should certainly want to take a look at the cost structure of the policy, and you easily do that by printing it out on WinFlex. But absolutely, that's one of the reasons why we're seeing really exponential growth in our IUL sales, is because people are looking for a policy that does build really good cash value, but is also safe, has a guaranteed refund option rider, and has that low cost structure.
Right. So as you call in and you're working with our design team, you'd be seeing Mutual of Omaha's products being offered. Remember, there's more than just an indexed universal life. A lot of great features, feature-laden product when you have the chronic illness always included. And we've even seen cases, we've had a case where it was early onset of Parkinson's, doing very well, but that would be a kick out for any product with a long-term care rider. No way that could be underwritten to add that. But with Mutual of Omaha always including in the guaranteed refund option, or excuse me, the chronic illness, it was available. With great underwriting, but great to see. So Dave, really appreciate. I know we have some other Husker fans in the audience. Steve Berge in our group is full blood, bleeds red, Husker.
Go Big Red.
Go Big Red. So thanks for your time. Would you give us is there any questions that have come up other than that? Okay. Could you give me a number between 1 and 25 for our drawing, Dave?
I'm going to say 5.
Number 5. Who's the winner? Who's the winner? The winner is Adam Gallant. You'll be getting a Starbucks gift card and a CE voucher.
Great.
So congratulations today. All right. So we will next week just want to tee up our brew. You ever wonder how an indexed option within an indexed annuity would perform against its competition between other indexed options with other products? Doug Twitty, our Director of Annuities, is going to walk us through Indexalizer, a tool that really does phenomenal analysis. So you're going to want to take a look at some of the options that you have available to show your clients on your due diligence, your research, and why you're recommending certain index features. So join us next week with Doug, our Director of Annuity, walking through Indexalizer. Thanks everyone for joining the brew. Have a great week.